Welcome to Burns Hustles, where we turn side hustles into cash. In the ever-evolving world of finance, there is one question that stirs the minds of both seasoned investors and beginners alike. As we stand at the precipice of a new era in investing, the lines between traditional investments and newer, more volatile options are becoming increasingly blurred. Please like, subscribe, and comment. The recent surge in interest and capital poured into cryptocurrency has sparked a global conversation. The world is looking at an investment boom like never before, with digital coins at the forefront. And that is cryptocurrency a good investment? Before diving into the depths of this question, one must first understand what cryptocurrency is. Cryptocurrency, in essence, is a digital or virtual form of currency. Unlike traditional money issued by governments, cryptocurrency operates on a technology called blockchain. This is a decentralized technology spread across multiple computers, which records and manages all transactions. The digital nature of cryptocurrency means it exists solely in an electronic form. There are no physical coins or bills. Every transaction, every creation of a new coin, and every coin owned is recorded on the blockchain in a public ledger. Decentralization is another key factor of cryptocurrency. Instead of being controlled by a central authority like a government or a bank, cryptocurrencies are regulated by the network itself. This offers a level of freedom and privacy that traditional currencies can't match. Now that we've grasped the basics of cryptocurrency, let's delve into its investment potential. Cryptocurrency, a digital asset designed to work as a medium of exchange, is increasingly seen as an investment. An intriguing blend of technology and finance, cryptocurrencies have captured the attention of the global investment community. But why? Let's delve into the reasons. Firstly, the potential for high returns. Cryptocurrencies have exhibited a remarkable growth trajectory over the past decade. Bitcoin, the first and most well-known cryptocurrency, for instance, was worth just a few cents when it was launched in 2009. Today, its value has skyrocketed, reaching peaks that few could have predicted. This dramatic increase has led many to view cryptocurrencies as a get-rich-quick scheme. However, it's essential to understand that this is not always the case. Cryptocurrencies are volatile, and their values can swing wildly in short periods. Therefore, while the potential for high returns is undeniable, it's equally possible to suffer significant losses. Secondly, the growing acceptance of cryptocurrencies. As more businesses and institutions embrace cryptocurrencies, their legitimacy as an investment grows. Today, you can buy a cup of coffee, book a hotel room, or even pay for your university tuition with Bitcoin. This increasing acceptance not only boosts the demand for cryptocurrencies, it also fortifies their value as an investment. Lastly, the opportunity for diversification. Cryptocurrencies offer investors a chance to diversify their portfolios beyond traditional assets like stocks and bonds. This is particularly appealing to investors looking to spread their risks and potentially enhance their returns. In conclusion, cryptocurrencies, with their high return potential, growing acceptance, and the opportunity for diversification, are gaining prominence in the investment world. However, they are not without their risks. Their values can fluctuate dramatically, they're subject to regulatory scrutiny, and their future is anything but certain. Cryptocurrency can offer substantial returns, but it also comes with its own set of risks. As with any investment, it's crucial to do your research, understand what you're investing in, and never invest more than you can afford to lose. Wise investing requires a careful balance of risk and reward. Now, let's pivot to the more familiar realm of traditional investments. When we talk about traditional investments, we're referring to tried and true vehicles for growing wealth. These include stocks, bonds, real estate, and mutual funds. These are not just terms you'd hear in a finance meeting. They're the backbone of many a robust portfolio. Stocks, for instance, represent a share in the ownership of a company. When the company does well, so do you. It's like having your own small slice of a corporate pie. Then we have bonds, which are essentially loans you give to an entity, be it a corporation or the government. In return, you get a steady stream of income in the form of interest payments. It's kind of like lending your friend a fiver and getting six back. Real estate, on the other hand, is as tangible as it gets. It's the land, the bricks, the mortar. The value in real estate often comes from the potential for rental income, or the increase in property value over time. Lastly, we have mutual funds. These are a collection of stocks, bonds, or other assets managed by professionals. They allow investors to diversify their portfolios without having to individually manage each asset. What sets these traditional investments apart is their stability, predictability, and the wealth of historical data supporting their performance. They won't necessarily make you a millionaire overnight, but they've shown time and again that they can provide consistent returns and a sense of security. Traditional investments have stood the test of time, providing consistent returns and a sense of security. With a basic understanding of both cryptocurrency and traditional investments, we can now delve into a comparison. When we pull back the curtain, we find that traditional investments, such as stocks, bonds, and real estate, have been around for ages. They've weathered economic storms, have seen booms and busts, and have demonstrated the ability to deliver steady, albeit sometimes slow, returns. These are the old reliables, the trusted stalwarts of the investment world. Cryptocurrencies, on the other hand, represent a new frontier. They're the mavericks of the investing world, offering the potential for astronomical returns that traditional investments could only dream of. But as with any frontier, there's a level of uncertainty and risk that accompanies the potential for reward. Let's talk about the elephant in the room: volatility. Cryptocurrencies are notoriously volatile. One day, you're on top of the world, the next, you're in the trenches. This volatility can be a double-edged sword. It can lead to significant gains, but it can also lead to substantial losses. Traditional investments, while not immune to fluctuations, tend to be more stable. The stock market, for example, has a long history of upward trend, despite periodic downturns. Bonds and real estate, too, offer a degree of predictability and stability that cryptocurrencies currently lack. Then there's the influence of market conditions. Both traditional investments and cryptocurrencies are influenced by market conditions, but in different ways. Traditional investments are typically influenced by economic indicators such as GDP growth, inflation rates, and unemployment figures. Cryptocurrencies, however, are often influenced by technological developments, regulatory news, and public sentiment, making them a bit more unpredictable. In the end, it boils down to this: are you a risk taker, or do you prefer the slow and steady approach? Do you want the potential for high returns, or are you content with consistent, modest gains? Do you thrive in the dynamic, rapidly changing world of cryptocurrencies? Or do you prefer the more predictable, time-tested realm of traditional investments? The choice between cryptocurrency and traditional investments depends on one's risk tolerance, investment goals, and understanding of the market. So, is cryptocurrency a good investment? It's a question we've been tackling throughout this video, and one that, like any investment, doesn't have a one-size-fits-all answer. We've explored how cryptocurrency functions, its potential for high returns, and its inherent volatility. We've compared it to traditional investments, which typically offer stability but may not match the potential earnings of crypto. We've also underscored the necessity of understanding the market dynamics at play. Cryptocurrency can certainly be a lucrative venture for those who can stomach the risk. However, this digital frontier is not without its perils. High volatility means high risk, and the potential for significant losses is as real as the promise of substantial gains. In essence, cryptocurrency is a high-risk, high-reward investment. It's a game of stakes, where knowledge, intuition, and a bit of luck can lead to windfalls or wipeouts. In conclusion, whether cryptocurrency is a good investment or not ultimately depends on individual risk tolerance, financial goals, and market understanding. Today, we've embarked on an insightful journey exploring the investment potential of cryptocurrency versus traditional investments. We've delved into the definition of cryptocurrency, its origins, and how it operates. We've also taken a detour through the well-trodden paths of traditional investments, understanding their workings and advantages. A comparative analysis between these two investment avenues was carried out, highlighting their unique features, benefits, and potential drawbacks. We've seen that while traditional investments provide stability and are governed by established regulations, cryptocurrencies offer a high return potential coupled with an equally high risk. Our verdict: there's no one-size-fits-all answer. The choice between traditional investments and cryptocurrency depends on individual risk tolerance, financial goals, and market knowledge. Remember, every investment comes with its own set of risks and rewards. The key is to make informed decisions and choose wisely. Until next time, keep exploring, keep learning.